Trade wars aren't just headlines. They're quietly transforming the foundations of the global economy. Behind the policy debates and political soundbites lies a complex web of tariffs, shifting supply chains and evolving trade agreements that are reshaping how goods move across borders. But what does the data actually tell us? In this video, we'll break down the latest trade numbers, uncover who's benefiting, who's struggling, and what the future of global trade might look like if current tensions continue or escalate. If you care about global trade, economic policy, or the supply chains that impact everything from your groceries to your gadgets, you're in the right place. Make sure to like this video, subscribe to the channel, and leave a comment on what trade trends you're seeing or concerned about. Your support helps us bring this kind of high-value, data-driven content to more people in the trade and business community. Despite the turmoil, not everyone is losing. Some countries have capitalized on the shifting trade winds. Vietnam, for example, has seen a boom in manufacturing exports, especially electronics and textiles. As companies like Samsung and Intel expanded production in the region, Vietnam's exports to the United States surged, increasing nearly 30% between 2019 and 2023. The country has also signed over a dozen trade agreements in the past 5 years, making it a preferred hub for China +1 strategies. Mexico has also emerged as a winner. With the United States increasingly focused on nearshoring, Mexico has overtaken China as the United States' top trading partner in sectors like electronics, auto parts, and industrial machinery. Tesla, for instance, announced plans in 2023 to expand its gigafactory footprint in northern Mexico to serve United States markets tariff-free under the USMCA. India is making its move as well. The Indian government launched a production-linked incentive (PLI) scheme to attract foreign investment in electronics, pharmaceuticals, and solar manufacturing. Apple now assembles a growing share of iPhones in India with plans to produce up to 25% of its global supply there by 2026. On the losing side, small and medium-sized enterprises, SMEs, have been hit especially hard. Many lack the legal and logistical resources to adapt to sudden tariff changes. In the United States, importers of tools, packaging, and intermediate goods have seen profit margins shrink due to unpredictable duty hikes. The agricultural sector remains a pressure point. United States soybean, pork, and dairy producers saw their Chinese export markets evaporate overnight during retaliatory tariff phases. Though some regained access under bilateral agreements, global competition from Brazil, Argentina, and the EU has made it difficult to reclaim former market share. China, once the world's factory, is also under strain. United States restrictions on advanced semiconductors and the blacklisting of firms like Huawei and SMIC have disrupted China's ambitions in high-tech sectors. Analysts now suggest China's path to self-reliance in chip manufacturing could take another 5 to 10 years, if at all achievable under current sanctions. Meanwhile, some traditional trade alliances are fracturing while new ones emerge. BRICS, plus, now including energy powerhouses like Saudi Arabia and Iran, is exploring alternative trade mechanisms, including cross-border payments in local currencies, to bypass United States dollar dependence. So, what should businesses do when the trade landscape is in constant flux? The first step is diversification, not just of suppliers, but of entire supply chains. Relying on a single country or region, especially one entangled in geopolitical tensions, exposes companies to risk. Many firms have adopted the China +1 strategy, where China remains a key node but secondary production hubs are added in places like Thailand, Mexico, and Poland. Multinationals like Nike, HP, and Dell have all made public moves to redistribute their manufacturing footprint in recent years. Some are even embracing multi-shoring or friend-shoring, shifting production to politically aligned nations. The United States has signaled strong support for reshoring critical sectors such as pharmaceuticals, semiconductors, and defense manufacturing, with tax incentives and federal funding under legislation like the CHIPS and Science Act. Second, companies are investing in real-time visibility and risk forecasting tools. Platforms like Project 44, 4Kites, and SAP Integrated Business Planning help companies track goods in transit, monitor supplier stability, and simulate disruption scenarios, something that was once considered a luxury, but is now essential. Third, businesses must stay ahead of regulatory changes. United States Customs and Border Protection, CBP, regularly updates enforcement guidelines, particularly for Section 301 and 232 tariffs. Firms that fail to monitor changes risk fines, delayed shipments, or costly rework. Trade compliance officers are no longer back-office roles, they're now central to operational strategy. Moreover, there are government programs that remain underutilized. Free trade zones, FTZs for example, allow businesses to defer, reduce, or even eliminate customs duties on imported goods. Duty drawback lets companies recover duties paid on goods that are re-exported. The Miscellaneous Tariff Bill, MTB, temporarily suspends or reduces tariffs on certain imports not available domestically. For small and mid-sized importers, these programs can be lifelines, but only if they know about them and invest in the right compliance infrastructure. And finally, adaptability and innovation are becoming competitive advantages. Companies that pivot faster, whether by finding new suppliers, redesigning products to avoid sensitive components, or leveraging digital twins for supply chain planning, are the ones that stay ahead. Uncertainty is the new normal in global trade. The winners won't be the biggest or the fastest. They'll be the most flexible. Looking forward, global trade isn't vanishing. It's evolving into a more fragmented, strategic, and digitally driven system. The post-World War II vision of open, rules-based trade under institutions like the WTO is being challenged by a new reality: geoeconomic competition. We're entering an era of selective globalization where nations trade freely in some areas, like consumer goods or digital services, but fiercely protect others, such as semiconductors, energy, and critical minerals. Trade is no longer just about efficiency, it's about resilience, security, and sovereignty. Governments are redrawing trade priorities based on national interests. The United States is pursuing foreign policy for the middle class, targeting domestic industrial growth. The EU is championing strategic autonomy, and China is pushing its dual circulation model to boost self-reliance. These policies are creating new winners and new bottlenecks. Technology will be central to this transformation. AI-powered logistics, blockchain-enabled customs clearance, and autonomous port operations are streamlining trade flows while also increasing the stakes. But this tech shift isn't evenly distributed. It favors nations and corporations with access to capital, skilled talent, and advanced infrastructure. There's also a growing emphasis on sustainability and ethical trade. The EU's Carbon Border Adjustment Mechanism, CBAM, which imposes emissions-based tariffs on imports, could become a global template. Companies will need to track carbon data across their supply chains to avoid penalties, a significant challenge for those sourcing from regions with less transparency. Digital trade agreements like the DIPA, Digital Economy Partnership Agreement, and the Indo-Pacific Economic Framework, IPF, are emerging as new frameworks. They focus on rules for cross-border data flows, digital standards, and AI governance, critical areas for future commerce. These aren't traditional tariff-based deals, but they may define the next generation of trade rules. Emerging markets, too, have an opportunity to leapfrog. Africa's AfCFTA aims to unify 54 nations into a single trade bloc, potentially creating one of the largest free trade zones by population. If successful, it could unlock massive intra-African trade potential and reduce external dependency. And finally, the role of consumers cannot be overlooked. From sustainable sourcing to transparency in labor practices, buyers are increasingly demanding accountability in how goods are made and traded. This is reshaping how brands position themselves globally, not just on price, but on principles. The road ahead won't be smooth, but it's rich with opportunity. The next phase of globalization won't be defined by uniformity but by adaptation to data, to policy, and to a changing world. Final thoughts. Trade wars are more than political talking points. They're data-driven transformations of how the global economy operates. The winners will be those who stay informed, flexible, and forward-looking. That means watching the data, adapting supply chains, and embracing the technologies and policies shaping tomorrow's trade landscape. If this analysis helped you make sense of today's global trade shifts, please like the video, subscribe, and share your thoughts in the comments. Where do you see trade going next? Sources are listed in the video description.